Hello, I'm Russ Mould, AJ Bell's Investment Director, and welcome to Fundamentals, our regular look at the world of funds where we assess which collectives are the most popular purchases on the AJ Bell Investcentre platform and then investigate why this might be. Now this week, fifth on the list for actively run funds is Fidelity MoneyBuilder Income. This is a fixed income fund run by Ian Spreadbury, who will, coincidentally, be speaking at our Investorville event in London on the 19th of November. Just note, by the way, that this fund should not be confused with Fidelity MoneyBuilder Dividend, which is managed by Michael Clark and covers equities. Now, Fidelity MoneyBuilder Income invests directly in fixed income securities, although it can also hold cash, money market instruments and other collectives, as well as use derivatives. It can also go short, and its benchmark is the Barclays Sterling Aggregate Corporate Total Return Index, and the collective has a 4-star rating from Morningstar. Now, the current portfolio breakdown is shown in the graphic behind me. Just over 2/3 of the £3.2 billion in assets are invested in corporate bonds, with 17% in cash and 10% in government debt. Now, that weighting towards corporate paper explains, or certainly helps to, the 3.6% yield, which more than offsets the 0.56% fund ongoing charge, and is also probably the most likely reason for advisor and client interest in the fund. This premium yield looks to come from two main sources across the 370 bond holdings. First, the maturity range of the portfolio. The effective maturity of Spreadbury's fund is currently a fraction under 19 years. The chart behind me shows the mix by maturity by different time periods. The second reason may be the quality of credit held. This on average is BBB, 2 notches above sub-investment grade or junk. So clients who are seeking some portfolio ballast from fixed income, but willing to take some extra risk in an attempt to eke out some extra return, may therefore find the fund's yield tempting, especially as the macro backdrop is still one of low rates, low growth, low inflation, and delays in central bank rate hikes. After all, the Bank of England has yet to raise base rates from their record low of 0.5%, after nearly 7 years, and the UK 10-year gilt yield is hovering at around just 1.8% as I sit here today. And inflation, well, that's zero according to the Consumer Price Index. Figures from Morningstar suggest that Fidelity MoneyBuilder Income has underperformed for each of the last 3 years, as this final graphic shows. Now, the fund's positioning and 8-year average duration mean it could still benefit from any prolonged delay in central bank interest rate hikes and a long period of subdued inflation. Under such a scenario, history would suggest the collective's holdings could provide capital gains as well as coupons, though as we all know, the past is no guarantee for the future. Whether you side with Spreadbury or not may come down to your personal macro view. Some advisors and clients continue to use bonds as a source of portfolio ballast, not to say welcome coupons, at a time when reliable income is not exactly easy to find, and when central banks have yet to prove they can drive inflation towards their 2% targets, even after 6 or 7 years of trying with low rates and unorthodox monetary policy. Skeptics will counter that sovereign bonds are no more than certificates of confiscation, the value of whose coupons will be eroded by loose central bank monetary policy as they relentlessly pursue their 2% inflation targets. Bond bears will also add that corporate investment grade and high yield debt offer yields that are still too thin to offer any margin of safety in the event of an inflationary spike. Which camp applies to you will depend on whether you believe inflation, stagflation or deflation will be the eventual outcome of low rates and QE, and that view in turn may shape whether you feel Fidelity MoneyBuilder Income is suitable for your client's investment strategy, target returns, time horizon and appetite for risk. Thank you for watching, and I look forward to seeing you next time.